Every year, there's a stock that people say you will regret not buying. Today, I'm looking at the one that they're calling to be one of the biggest opportunities in 2026. And we're actually going to find out how much truth there is to that. Guys, when I see headlines calling for a stock that's a can't miss or calling for a stock to go to the moon or skyrocket, I pause. You should immediately pause, because here's what I know. That statement is so powerful. It drives so much emotion. It's designed to get your attention. But what matters is not the headline. It's the substance. It's the numbers behind the business. In this video, I'm going to walk you through a stock that's currently rather hyped, and then we're going to run through the stock through our principle-driven investing process. We're going to look at the price, but more importantly, we're going to look at its value and the story to see if this is just another hype headline or is it a rare opportunity hiding in plain sight. And I'm going to tell you what price I would pay for the stock using the tools behind me. So here's the title of the article behind me. One super semiconductor stock to buy hand over fist in 2026, according to Wall Street. Now, right away, let me be very clear. This is not my opinion. I'm just walking you through what this article is stating, and we're going to look at it together through the lens of a real investor. The company in the spotlight here is Taiwan Semiconductor, ticker symbol TSM. Wall Street analysts are saying this stock could have a great 2026, and the article points to a one-year price target of $342. Guys, that is 20% upside from the stock is trading at this very moment. To put that in perspective, the average stock market return is around 8 to 10% per year. So this would be more than double that. The article says this could be a stock to buy hand over fist. But let's walk through the reasons they give, and you can decide for yourself if it makes sense. Guys, my goal here is not to tell you, you need to think like me. My goal here is to say, listen, I have been around investing and I've seen a lot of things come and go. I want to explain to you the way in which I think, why I think it. But it is your job to decide, does this guy make sense or is he an idiot? Now, first off, they point out that TSMC is a critical player in the AI space. Most people hear about NVIDIA, AMD, but not TSMC. The difference is, NVIDIA and AMD design the chips, but TSMC actually builds them. So if AI continues to grow, the thinking logically is TSMC will benefit right alongside those big names, even if they're not as loud in the media. Now, the article also talks about their new 2-nanometer chip, which is huge innovation, guys. These chips use about 25 to 30% less power than the 3-nanometer chips we have now. And guys, if you've heard a lot of things, the power being eaten up by AI is huge. So if TSMC can help companies save on energy, that's going to be a strong long-term advantage. Financially, the article points to some impressive numbers. Their third quarter revenue rose 41% year over year in US dollars. Guys, that's big growth, especially for a company that large. And it supports the idea that AI demand is not slowing down. In fact, it may be accelerating. Now, the article also references forecasts from NVIDIA and AMD, who both expect massive increases in global data center spending. This is the heart and soul of AI. We're talking $3 to $4 trillion by 2030. And if that happens, TSMC is expected to be one of the biggest beneficiaries since they're the ones producing all the chips that power those systems. Finally, the article makes the case that TSMC is reasonably priced compared to other AI-related stocks. It's currently trading at about 28 times forward earnings. Guys, that's not cheap. But NVIDIA is at 38 times and AMD is at 55 times. So by comparison, TSMC could be considered the value play in the group. This is the case the article is making. Big upside, critical role in AI, strong revenue growth, industry tailwinds, and a valuation that's lower than its peers. We got to slow down for a minute, because this is where a lot of new investors get tripped up. Just because an article or someone on YouTube says a stock should be bought hand over fist doesn't mean it actually should. Especially, and I really truly underline, accentuate, highlight, italicize the word especially, in hype-driven markets. We've seen this year after year. The hype continues, the characters change. People throw around these flashy labels to grab this attention. Guys, I repeat till I'm blue in the face. Hype is not a strategy. It's a distraction from what works in the long run. The number one principle you have to understand: price is what you pay, value is what you get. That's it. That is the golden rule. If you're paying above value, you're going to end up doing poorly. If you play below value, you're going to do well. And for anybody who thinks that's not possible in the markets, you haven't looked at history long enough. And also, you haven't looked at best performers of all time. Now remember, it does not mean that you value every company with the same 15 times earnings or whatever you want value at. Faster growing companies, better companies deserve a higher premium, but there's still a value you're getting for that, and your goal is to still pay a lower price. A stock is only a true buy if its price is below the value of the business behind it. Think of it like buying this iPhone. Great iPhone, $1,000 iPhone. If you were able to buy it for $500, is that a good deal? Of course it is. But if you pay $2,000 for the exact same one, just because everyone else is excited about it, you're going to lose a lot of money. That's not investing. That's following the crowd off a cliff. So before you believe the hype, ask yourself this one question. Do I actually know what this business is worth, or am I just getting swept up in someone else's excitement? Now, a lot of people out there will sit there and say, no, I know what the business is worth. And we'll say a lot of words and terminology that make us feel that way. But at the end of the day, business valuation is about looking at the numbers. Investing is not about headlines. It's about discipline, logic, and buying great businesses at great prices. Now, guys, if you've been in our channel for a while, you know this. But if you're new to this, I really want you to hear this. I don't consider long-term investing to be the IRS definition of 1 year or longer. I look at long-term investing as years and years and decades. If you see the companies that I want to buy, they're companies I look at saying, will this company be around for decades? Guys, can I tell you something? Taiwan Semiconductor, I think will be around for decades. So what do you hit that criteria of this company is a great company that'll be around for a long time? So what's the next question? Can I pay a reasonable price for this? And can I figure out within reason how much money the company will make as time goes on? When I say that, I really mean is, can they make a substantially higher profit 10, 20 years down the road that if I pay a reasonable price today, I'm going to make a good return? So now, this is why I teach on YouTube. Because what I saw on everybody out there, not just YouTube, I'd meet with bankers and they say the exact same thing. Oh man, that's a great company. They're doing great things. You should own that stock. I heard nothing about valuation. Nothing about it. I see it on YouTube. Somebody buys a stock and it goes to the moon. They think, look, I'm an investor. That's not the case. Even if you buy something and you're right, doesn't make your reason for buying correct. That's determined over many, many investments over many, many decades. This is exactly why I'm teaching. So now it is time to dig in. Let's analyze Taiwan Semiconductor the everything money way. We're going to look at the fundamentals, the cash flow, the long-term prospects, and most importantly, we're going to try to figure out what price makes sense for us to buy this stock today using the stock analyzer tool. So Taiwan Semiconductor is already up 50% this year. To an investor, that doesn't matter. That's why I bring it up. Everybody's going to go to that and say, this is awesome. It's up 50%. You should buy. No. To me, I heard it's 50% more expensive than it was January 1st. It could still be a good deal, though. We're going to look at that. It is a $1.56 trillion market cap business, which means if we buy every single share on the market, we'd own the entire company for $1.56 trillion. And even better, guys, their enterprise value is lower. That means there's essentially no debt on the company. That is wonderful. Now, something I don't like about the company that's been consistent for a long time. Their free cash flow was $28 billion last year. The last 5-year average was 17.5. Their net income was $50 billion last year, with $31.7 billion average in the last 5 years. This difference between free cash flow and net income is no bueno. You have to understand why that is. A lot of value investors won't even look at this if the free cash flow isn't within 20% of net income. This is substantially different. Almost 100% higher. So that's a reservation I have off the bat. Now, some profit margin numbers. Look at this. 1 year, 5 year, 10-year profit margin. Guys, it got better as time goes on. I like that. And it makes sense because their gross margin of 59%, call it 60%, is very solid. Every time they sell a product, 60% of that money goes to the bottom line. At such a high number, it's easy to make this profit margin number go higher. So guys, imagine this. You have a company that's growing in revenue, and on top of that, every year their profit's getting better and better. We like that a lot. Revenue growth. Now here's the great part. $1.6 trillion company, Their acquisitions in the last 5 years have been 120 million. It's nothing. It's a rounding error. So this growth here is all organic growth. I love that. Now, obviously the chip sector has been very popular lately, but these are the things that I look at. And one more metric I want to follow. Well, actually a couple more. Look at this dividend. 1% eats up $14 billion of free cash flow. Return on capital, getting better. 5-year average 15%, 1 year 16%. For those of you who are new, this is a very important metric. How good is the company at making profit on the money that is invested in the business? As you can imagine, if a company can invest money in their business and grow the profit at 15, 20, 30%, it's way more valuable than a company that can grow it at 5%. These are good things. But this dividend here of 1%, it eats up too much of this cash flow. And to me, maybe it's the right thing to do, but it's the last thing you should do with your cash flow. And then finally, their price of free cash flow is 55. That's expensive. Our community members have this company as a hold with an intrinsic value of 293, and the stock's at 300 right now. All right, so nothing great to write home about. Let's go check out the 8 pillars here. So this is what's interesting on the 8 pillars. This is what tells us a story. It's not about 8 check marks we need. It's about understanding what you're looking at. Here, what I see is, I see a great company that might be expensive. These are the valuation metrics. Everything else here says revenue growth, profit growth, debt's low, all these things, great. We just might have an expensive business. But remember, I will say tell them blue in the face. If God came down and said, Paul, Taiwan Semiconductor is going to double its profit every year for the next 20 years, guys, I would sell everything I own to buy this company today. Before I go any further, I've thrown a lot at you guys. A lot of metrics, a lot of things like that. The good news is I'm not expecting you to memorize that. I've created an absolutely free cheat sheet that allows you to go through all of these metrics, explains it to you at your fingertips. That way you can understand things and also be a little cocky with your friends when you talk about numbers and investing. If you click the link below, give us your information. We will email you immediately this key metric PDF that'll explain to you all of these key metrics, why they matter, how we calculate them, etc. That way, when you watch other videos or look at other investments on your own, you have this ready to go. Keep it handy for you. That way you can understand the metrics as you go on. Now, analyst estimates. Well, it's interesting. It's good growth. Earnings per share, 40% higher than last year, 20%, 20%, 11, and actually a slight dip here. Not exactly booming here for this AI boom they're talking about. Even though revenue growth, this is what's not consistent with me. Look at this revenue growth. Big time growth, 30, 21, 21, 11, and 8% revenue growth. But yet, so revenue almost doubling and profit only going up 50%. Seems kind of weird to me. But these are the things we have to look at. These are all increasing our questions we have to ask. But remember, I don't believe in going and doing the deep dive yet. That's an absolute waste of time. Next, we're going to go into the stock analyzer to sit there and determine the right price. Because if the right price is close to this number, we do more research. But if it's far out there, let's say the stock's at 300 right now, and stock analyzer says it's worth 30, why spend any more time? Guys, most investors are gonna lose money because they're trying to pick the next big winner. But the best investors do the opposite. They eliminate the losers first. That's what we're doing here when we analyze a stock. And that's why I use Stock Analyzer first. I want to say, let me make some reasonable assumptions about the future. And if I'm nowhere close, why spend any more time? Every time I spend in a company that doesn't make sense financially, I'm taking away from a company that does make sense. I want to spend my time. You should want to spend your time on that. And guys, little spoiler alert, we have a class coming up in 2026 that is going to make deep research a lot easier for everyone here. So stay tuned for that one because it's going to be a game changer for research. Now, we're here to Stock Analyzer. Let me pull up the last time I did Taiwan Semiconductor. It was last year, actually. Oh, wow. Wide range of revenue assumptions. So first off, guys, I do a 10-year analysis. Now, I did 1, 7, and 13% revenue growth because I really had no idea. Let's tighten this up a little bit. 4, let's go 5, 10, and 15%. So I went higher on the low side, higher on the high side, and higher in the middle. So I'm still giving it some good revenue growth assumptions. It seems hard to think about that when revenue growth has increased. But I believe that these hype industries, they start to look at EV. That was going to be everything. And now you see all these companies pulling back on EV, like, we're not going to spend so much on it. Just remember that. Profit margin. I did 35, 38, and 41. But guys, look at the free cash flow. This free cash flow is a lot lower. I'm going to go higher on the free cash flow down here, but not much higher. I'm going to go 20, 23, and 26. Now, what is the right PE and price of free cash flow for 10 years from now? Not for today, not for 5 years from now, 10 years from now. Well, guys, the market average is 15 to 16. But remember, a good company deserves a premium. A bad company deserves a discount. I would say this is a good company based on returns on capital, based on their margins, based on their balance sheet. So I'm going to give this a premium. I'm actually going to change this to 17, 20, and 23. And finally, what is the desired return I want? Now, for those of you out there who use Stock Analyzer, you know not to put 9% in here. This is just my intrinsic value price. Hey, what's this company worth? 9% will give me that. But remember, if you're buying an individual company, you absolutely need to have a margin of safety because we're humans and we make mistakes and the future is unknown. But I just want to sit here and see what's the company worth. So now we hit the analyze button, go down below. Guys, we have a low price of 90 to 150, a high price of 300 to 470, middle price of 160 to 270. Now, if I focus on discounted cash flow, I really have to understand why is there a difference between cash flow and earnings? For me, I'm a little apprehensive about this. I'm probably going to wait a little bit, maybe add it to my watch list right now at $180 a share. That way, when it goes below there, I know to go start doing more research on it. Now, you might be different than me. You might sit there and say, no, Paul, I think this company is worth $300 all day. Well, I can still figure out a way to get this company at a cheaper price and be paid for it. Let me show you how. This is our options chain. What I'm going to do is I'm going to do what's called sell a cash secured put. This allows me to go out at some date in the future. I pick January 9th and pick a price. So I'm going here to puts. Let's say I want the stock for $280. Well, guess what? Somebody's going to give me $4.60 per share to wait. And if the stock hits below 280, I get the stock and I keep my $4.60. So it's like I bought the stock for $275.40. And guess what? That cash along the way is earning me 18.7% per year. So what did I just say? I literally just said I'm getting paid an annualized 18.7% a year to buy a company I want at a price lower than what I like. If you think the stock is worth $300 all day. This is what I do to get a return on the cash invested in my business and to buy stocks I love at lower prices. So if you're looking to generate real cash flow on stocks you own and cash you have sitting, this is your way to do it. We got our next options class coming up at the start of the year, and this is exactly what we're going to teach. You can take the stocks in your portfolio and generate income off of it, and you can take the cash in your portfolio and generate upwards of 10, 15, 20%. So if you want in the class, you need to click the link in the description of this video. Spots are going to be limited, so make sure you get yourself on the list. Now, guys, earlier this year, I picked 7 stocks, my own personal Magnificent 7, to go head-to-head with the actual Magnificent 7. Click the video on your screen to see which 7 stocks I picked and how they stack up. The results will surprise you like they surprised me. Thank you for your time.